Good evening, everyone. Today we're going to talk about my portfolio on 6/17. What are the moves that I've made as of Friday and as of today? So as you can see from the past week, so it was about, I believe, Thursday. Yeah, from about Thursday, I was sitting around 44K. At the lowest point that I hit today, I got to, I think it was about 35, 35K. And then now I'm sitting back around 37-ish, 38-ish. So quite a fluctuation. The reason being is that because what am I doing with my portfolio? Well, this is the amount of money that I'm using, but I essentially use margin to buy almost double the amount of stock for SoFi. The reason being is that I think it's a solid stock pick. So this is not a good idea. So using margin, generally speaking, the reason being is that if it were to go down dramatically, then you would get margin called, and then at which point you would either have to post more funds. So essentially, you would have to deposit more into your account, or you would have to sell effectively at a loss. Now, so selling at a loss is a terrible option. Putting more capital is definitely possible. However, depending on how leveraged you are, it just depends on if you have that amount of cash available. So I do have some money available to go ahead and put in here, but as you can see, my margin is currently sitting around 43.5K. So at the moment, I don't have that to put in. At the moment, I could put in a little over 10 or so, but so this is why it's not generally advised. The reason being is that you don't want to potentially wipe yourself out, right? This is how accounts could get potentially wiped. Now, you might be asking, like, why do I do this if I'm saying that I don't recommend this? The reason being is that I think that SoFi is generally at a really good price point for me, personally, for me. And I don't think in terms of like price to book, in terms of its EPS, the positive trends, its future guidance, or, so there's a lot of things going for SoFi. So I don't really see it being at a risky position. On the contrary, you could look at stocks like GameStop, right? Like GameStop or anything that's overvalued. Like what's another one that may be potentially overvalued? Don't want to pick on anyone too much. Like Reddit. Reddit's overvalued in my opinion. What's another one? A lot of them are overvalued right now. I think not necessarily overvalued, but fairly valued. When stocks are fairly valued, you're in a tough position. Like I think Google is fairly valued at the moment. I think Verizon is fairly valued at the moment. Snapchat, I think, is overvalued at the moment. Meta is fairly valued at the moment. And the problem with fairly valued or overvalued stocks is that they have more room to fall. So think about it in terms of a car, and think about its book value. So the book value on a car is 10 grand, and the price that you're selling it for is 10 grand. Well, you could still kind of shortchange it quite a bit. You could still get it sold as a loss. So maybe some people are offering 9 grand, 8 grand, and you might accept it just to sell it. So there's more kind of wiggle room down. It might even go down to, like, let's say 7 grand, potentially, on depending on your situation. But let's say, for example, if it were selling, so it's worth 10 grand, but its current price that they're willing to buy it at is 5 grand. That's kind of ridiculous. Like there at 5 grand, it's getting to a point where it's so undervalued that you can really start finding buyers anywhere. You're not really going to feel pressured to sell it at that price point. The same thing with the stock. If it's undervalued, really, it's very unlikely, or generally unlikely. I don't want to say really unlikely, but generally unlikely for it to go further down, especially if its fundamentals are going up and up. That doesn't really kind of go hand in hand with cars, because cars don't get better over time, right? They just generally depreciate. But just imagine if your car was getting better, I don't know, modifications to it, sound system and so forth, maybe fuel efficiency added to it, then its value should go up. And and if it was still at a low price point, more people would be stepping in to buy it, and more people would be excited to buy it. Now, when it's overvalued, let's say if the car was worth 10 grand, but you were selling it like during the pandemic and you were selling it for 17 grand, 20 grand, 30 grand. Well, of course, you're going to be a negative in equity in the future. It's going to go ahead and have its fluctuation downwards. You're at a high risk. So all this is to say is that because I think SoFi is a solid company, number one, and number two, it's at a good price point for me personally, then for me, I don't feel kind of nervous about leveraging myself in this instance. Only if I was doing it on a fairly valued or overvalued company, which I wouldn't do. So that said, what else am I doing? So we know that I've been selling covered calls on some of these shares. So since I have 13K shares, that translates to 130 covered calls. But let's look specifically at like my last few trades. So let's go back. Because I did make a few trades recently. I think I may have covered them last week, but I want to cover one that I did today. So starting on the 13th, yep, I purchased my shares at $7. I went ahead and sold the contracts for 7 cents. And then I bought them back at 1 cent. So I effectively lowered my cost basis by 6 cents. So $7 minus 6 cents. So I own these shares at $6.94 a piece. So essentially $6.94 is what I own these shares at. Now this morning, I actually sold the contracts at 8 cents and it went down, and I actually bought them back for 6 cents. So I actually effectively lowered it another 2 cents. So I'm down to $6.92 a piece. Okay, so that's my cost basis effectively. Then I went ahead and saw that SOFI was going, so it reached an all-time low of like $6.30, or sorry, not an all-time low, 52-week low, so a yearly low of $6.30. Once it started going back up slightly during the day, I went ahead and sold some contracts for the end of July for 24 cents a piece. So it's not ideal because ideally I would have wanted to wait for a rebound, but I'll explain exactly why I did this. So I sold them for 24 cents a piece, or effectively 3K. So what that means is if I get back to $7, I would profit the 24 cents plus the 8 cents difference. So 24 plus 8 is 32 times 130, about 4K. Yeah, so effectively from when I purchased those shares, I think my cost base, so the amount that I had at that point was, wait, so it was 13,000 shares. Actually, we could just see it from here. How much I'm down. So there's a simple way to do this. So once again, if it goes up, I'm up 4K, and then you would just have to add it from its current price. So actually I'm down 50 cents, right? So you could see because of that 50 cents, it's down around 6.5K. So just to do the math a little bit, 37.5 plus 6.5 plus 4, and then that amounts to 48K. So if it goes back to $7 by July 28th, I'm back up. So that's why there's kind of crazy fluctuations, just because once again it's leveraged twice the amount, so it'll swing much more wildly in that sense. But why would I sell these covered calls, especially if I think that this stock is undervalued and it has the potential to go up much higher? Well, it's just because I, have taken the stance to not try to be greedy, in the sense that yes, it can go up to $8, $9, $12, especially in the long run. I do think it has the potential to be a very well-priced stock, or really good company. However, in the short term, markets can be very irrational. And as a result, there's a saying that says, markets can be irrational longer than you can be solvent. So you can actually get bankrupted in the time that the markets are just doing dumb things, which is undervaluing companies or overvaluing companies. If you're undervaluing, that hurts you when you're going long, and then overvaluing when you're going short a position, and it ends up overvaluing, like in the cases of AMC and GameStop and so forth. So in that case, since I am levered twice the amount, I would want to go ahead and minimize or reduce my risk by selling these covered calls. So effectively, I would get from 690, I think we said 692, right? 692 minus 0.24. Let's say it wasn't $7. My new cost basis would be $6.68. So even though it would, let's say it stays at around 650, which is its current price, pretty low, then I'm at a good position because I'm only really effectively down 18 cents per share. So that's how I can protect myself. Another reason why I specifically chose this expiration date, it might seem obscure, is that this is also something very important to consider, is that this is right before earnings. Now, I want to sell these right before earnings because generally I can win twice. What do I mean by that? If I sell these contracts right before earnings, these contracts cost me, let's say, like 24 cents a piece. But for that 1 week, if we go back to the options, if we take a look at what was it, July 26th, you can see that this is 24 cents. But if I just go to the next week, because its earnings is within this next week that's happening, or before August 2nd, but after July 22nd or 26th, you can see that same contract is now worth 40 cents. So that's that's the 16 cents difference. So that's what, how much is that? About 2/3 of the price increase, right? 2/3 of the price increase just for 1 week. So what generally happens is I can wait for that 24 cents to expire. Hopefully it's still under $7. And then I can rent it out again for ideally more than 24 cents, and just for 1 week. So that's going to be a huge profit. The downside would be if the stock goes down further and further. So and then that case, even though it's still earnings week, it would have to be, it would still be a lower premium if the price was lower, because of course, as the stock price goes in the opposite direction of your position, so as it goes down, in cases of calls, the call value gets devalued, right? So this becomes less valuable as the stock price goes down, right? In other words of saying that. So that's kind of what I'm doing at the moment. Once again, if I was just purely cash and or not cash, but if I was just purely shares without any margin, I wouldn't have sold these calls. I really would have just held on until the price kind of kicked back a little bit, as I think it should. I believe in the short term it might go back to like around $7, maybe potentially like 7.50 or so. In the long term, I think it's higher probability of going upwards, but in the short term, it's tough to say. No one can really say what's going to happen in the short term, so it's best to minimize risk. And if someone does tell you they know exactly what's going to happen in the short term, this is something I will tell you that I do recommend, is you walk away from them. They're just feeding you lies. There's no guarantee, unless of course they're like insider trading, or the kind of like part of the government. They have access to that, and they have access to certain deals. That's a whole nother thing that's illegal, of course. So that's a whole separate thing. But other than that, like let's say if it's someone on YouTube or anyone who's telling you, I know for a fact this is going to happen, then, and especially in the short term, that's where it's lie. In the long term, someone can tell you something with very high confidence. So someone can tell you, hey, like in a few years, Google is going to go up. Yeah, of course, it's has solid profits. It's a massive giant. It has a lot of marketing, has access to all your keystrokes, all your search. It's a search engine that can kind of be able to more effectively market any kind of product. So there, in the sense, it's obvious that it's going to go up. To what degree, that can be debated, but it's very, very likely, very certain it's going to go up. But for the short term, you never know. Is it going to correct? And suddenly you lose. Suddenly, what did we see last year? Facebook went from $500 to $100. You just never know what happens in the short term. But that said, that's what I'm doing at the moment. I'm just holding on to my position until the end of July, and then waiting for this to expire, and at which point I'll go ahead and make my next move, which is the week after. I'll rent them out again. What that means is, with the cover call strategy, is it's not as exciting as day trading, in the sense that you're always trying to do something, but it's pretty consistent, right? It's pretty consistent. It's less risky. I don't have to worry about what's going on. The only way I would take some action is if the price were to go up dramatically. Like let's say the price went up to like $8, $9, then suddenly I can exit my position probably with some profit earlier. Or with most of the profit earlier. It just depends on how much it shoots up. That's a possibility. Or if the stock price goes way down, then I could buy this back for pennies on the dollar. So instead of 24 cents, I can probably buy it back for maybe like 5 or 10 cents and gain that profit. Of course, I would be in a difficult position because it would be low. But another reason why I pick SOFI stock is because of its margin requirements. So this is also important to look at if you are looking to get into margins. This is not financial advice. I'm not a financial advisor, but it's important to know what your margin requirements are. So if I am levered like this, I only need 30% of my maintenance, or 30% of the original money to keep it without getting margin call. So this is effectively what percentage I need to retain so that I don't get margin called. Lower than this, that's when they tell me, hey, you either have to deposit more money or you have to sell your shares immediately. So that's what you can see on here, which is kind of nice and convenient. If I bring this down, you can see what my buffer is, essentially how much further I could go down in terms of my account. So 37, I can go down around 15K and I would still not be margin called. So I would have to go down to about, what's that, 22K. All right, so I still have a lot of wiggle room in the sense of even if it goes down, I'm still not going to get margin called. These are flexible, however. So sometimes if the stock goes low enough, the margin requirements get higher and higher, and or in times of volatility. So that's something I also watch out for, because that's something that can ruin your plan pretty fast. And once again, just in the short term, you never really know what's going to happen. While I am confident with SoFi, just take a look at this. -60, -55. Yeah, so I was very confident before about Bitcoin miners, still was confident about Bitcoin miners. I still think they're great. They've already kind of popped up before I was able to capitalize on the gains, but it just goes to show that you never know how much something is going to drop or be irrational before you get to see it kind of execute how you expect it. So that's once again why I went ahead and sold these covered calls, even though it's not something ideally I would want to do. It's just I'm in a levered position, so I think it's just better to be safe about that and minimize risk. So at this point, I think I'm kind of repeating myself a little bit. So that'll be the concluding marks for this video. Thank you so much for watching. If you did enjoy, please like, share, and subscribe. And I'm going to go ahead and present daily stock material, or ideally daily stock material consistently. Thank you so much and have a great night.